Let's bring in Kevin Green, senior markets correspondent, right away to help set up the action today. All right, KG, listen, we only have 2 trading days left in the month. You're higher for the month, much better than many analysts, strategists, you name it, expected that we would be where we would be finishing this month. When you think about this month and you put things in perspective, how does that set us up for October?
Yeah, I think October could still be a little bit of a difficult month if you're just looking at it from a seasonality basis. And then also, if we do have a prolonged government shutdown, that could also kind of weigh on equity markets. But we have been able to exceed the street's expectations, at least for September. And a couple of dynamics did take place. Obviously, we had the economic data leading up into September that gave the Fed a little bit of the framework to start the rate cutting process and trying to cut maybe 75 basis points by this year, another 50 basis points left to go if you kind of look at it here. And that has been providing some optimism when it comes to the equity markets, as well as the lower bar that we have seen when it comes to the earnings outlook here moving forward. We continue to see those earnings being revised to the upside. So a low bar, higher earnings revisions to the upside is also a catalyst for equity markets just in general. And then the artificial intelligence theme, some of the deals that were announced for this month as well, weighing and providing a catalyst for a lot of these mega cap names, Intact, the Nvidias, the Oracles of the world, things of that nature, also moving higher here. So it has been conducive for equity markets, once again, staying at elevated levels, trading near all-time highs, but I still think that there's a risk in October that we could see maybe some liquidity drying up here, a pullback taking place, and maybe some buyers stepping in and trying to buy that dip.
Okay. I'm curious to know, though, because you mentioned different earnings targets, but you also have at the same time the S&P 500 targets increasing for the year end. And Jay Woods of Freedom Capital Markets puts out his note at the beginning of the weekend, pointed out that the last quarter of the year is seasonally strong and typically the strongest of the year. What's your thought on that?
It is, but October is actually one of the weaker months that we have throughout the year. So he is definitely right. If you're looking at the totality of October, November, December, it is fairly strong. But a lot of that strength comes in about the second week of November, leading up into Thanksgiving, and then obviously seeing that follow through, going through the holidays at the end of the year. And then that also leads to a low volume environment, low liquidity type of environment where we do see some buying pressure taking place, and then low liquidity and buying pressure just for the most part could actually move prices fairly aggressively here. So he's exactly right. But the October month, at least the first 2 weeks of October, is usually a little bit difficult for the market. We also will have a quarterly rebalancing taking place too at the end of September. That we have to be mindful of, and then also some substantial options repositioning if you're looking at the JP Morgan collar and things of that nature. So he's right. It just kind of depends on if you're taking a slice month by month. October's still a little bit tough generally. Okay. But once again, we could buck that trend like we did in September.
Okay. All right, KG, let's talk a little bit about the looming potential government shutdown. It feels like up until now, Wall Street was kind of dismissing it, but it does have some impact. It may not have had much market impact, but it can affect the economic data releases. So how do you think, what are you expecting in terms of the overall impact and the effect on economic data?
Yeah, it just depends on how prolonged the shutdown actually can go for. If you kind of look at it and look at the past, the shutdowns that only last for 3 days or even 7 days actually have been pretty decent for equity markets moving higher. And you do see yields for the most part getting bid up. But if you have a prolonged shutdown like we saw back in 2018, where we had, 35 days of a shutdown, we did see around a 6.5% to almost 7% pullback in the equity markets before moving higher. So it just kind of depends on where we kind of lay here. Now, there's when we are talking about a shutdown, there's discretionary spending and then there's non-discretionary spending. So some of the core services that the government provides will still stay in place. For instance, defense is still going to be in place and other mechanisms as well. But you might see like national parks, for that matter, actually shutting down. And this could have an impact when it comes to the labor market as a whole. Once again, it just depends on how long the shutdown takes place. Do we actually see those federal workers actually impacting the economy when it comes to consumer spend? President Trump is also threatening to cut federal workers if we do see a shutdown as well permanently as a result of this. And that could also weigh on the overall labor market. Now, Friday, could we be at risk for the BLS data not coming out? That could be the case. This is not the first time that we've seen this, though. We'll probably weigh a little bit more heavily on the ADP data that will come out on Wednesday and leverage that a little bit more in the event that we do not get the Friday report.
Okay, all right. KG, let's talk a little bit about the chip sector. There's a Bloomberg report out this morning about Huawei ramping up its chip production. I'm not seeing a heavy impact to Nvidia, though. What's your takeaway here?
Yeah, I would agree. When you're kind of looking at Huawei, the report is that they're basically ramping up or pretty much doubling their production for the 910C AI chips here, actually boosting that production up to around 600,000 units by the end of 2025 here. And they actually could see that production increase by 1.6 million dies in 2026. So they are definitely trying to ramp up their AI chip production, trying to become less reliant on the Nvidia chipset as well as others that are provided from the United States here. But a lot of the chips that they are providing is really built for inferencing, not training, and which is kind of where the majority of the workload is probably going to come from moving forward when it comes to artificial intelligence just in general. So could this be a little bit of a situation for competition? It can, but Nvidia still has its own hurdles. H20s are still not being sold at this moment, from what we can tell, and they're still having some headwinds when it comes to China looking into their business and monopoly practices and things of that nature. So a lot going on. Huawei obviously is still one of the bigger players of artificial intelligence within China. It doesn't seem like that's going to change anytime soon.
And quickly, let's get your targets on the S&P 500 today, KG.
Yeah, to the upside, 6,700. To the downside, 6,545.
All right, 6,700 to the upside. There you have it. Thank you. That's Kevin Green, our senior markets correspondent.